Hey, what's up guys? Good morning and happy Friday. This is Taylor. Today's the 15th of February, and we got a long 3-day weekend ahead. Boo hiss. But we'll jump in here, guys. Lots to discuss. It's a tricky spot. A tricky spot indeed. So you've got the good, the bad, and the ugly. So we'll start with the good. And, the good might not matter here because of the bad and the ugly. But the good would be on your most recent push here that we've had over the last, handful of weeks. The indicator, the big 3 indicator that is, has finally gone bullish on the daily chart. So all that really tells us is trend and structure. So your MACD, your stacked EMAs, your moving average crosses, everything is finally shifted in the favor of the bulls. Now, it's obviously not a guarantee or a promise that we're going to rally into the sunset, but it does put the bulls in the best position they've been in for, going on a year and a half here to potentially take the market higher. So there's the good. Your S&Ps have gone bullish. Your QQQ has got daily buy signals for the first time in a long time. The semiconductors have been bullish. So that all looks really good. Your financials got a buy signal. The IWM, the little fella's got a buy signal. XLK has got a buy signal, and the equities, like AMD, for example, AMD's got the first daily buy signal in, a year and a half, 2 years. So there's the good. They've accomplished a little something here on this most recent push. They've shifted momentum. They've improved structure. They've put themselves in the best position structurally, at least as far as this indicator goes, to take the market higher. All right, there's the good. Now the bad and the ugly. The bad would be the recent strength here in the dollar. So any kind of strength in the Dixie, no bueno for the bulls. So you pull up the old dirty Dixie here. We've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, going on 12 closes back above that daily 21 EMA. And you can see the divergence here as the indicator's gone from bearish, suggesting path of least resistance is to the downside, to neutral. No more red arrow, no more red bar. So that's a divergence in the favor of the bulls. The trend broke, the structure broke. You got a pretty big dump. Then you got a really good dump. Now things aren't necessarily lined up for the bears. Doesn't make the dollar bullish. We're obviously not back in an uptrend, but that divergence just kind of tells you the bears don't have they don't got a full gas tank anymore. So not good for the market. And as your daily squeeze fires long here, I think the line in the sand is going to be 105-ish, which is your weekly 21 EMA. And that, I think, is where we're going to learn a lot about, where things are likely to head for the next handful of months here. For now, being that the indicator is bearish on the weekly chart, so we got a weekly sell signal, not the craziest thing in a potential weekly downtrend to flush. Rally back to the weekly 21 EMA, and then roll over again. So a couple of things to watch there. In the event we just rip through 105 like hot butter on your auntie's porch, the market's probably screwed. If we rally to 105 and pull back a little bit, then it's a matter of how does the dollar handle that pullback. Indicator goes from bearish to neutral. You've got some buy signals on lower time frames, so there could be a situation here where the dollar makes its first attempt to break through the weekly 21, fails, but then on the pullback you find support. The pullback begins to behave a bit more like an uptrend. You dip to a 21 EMA, you consolidate, you stabilize, then it could turn the corner again. So best case scenario here for the bulls. Before I'm putting on new trades to the upside, I've got to see a big break here. You need the dollar back under 103. Above your daily 21 EMA and certainly above 105, it's a big problem here for the bulls. And my thinking would be, we've probably got no shot. It's seeing this brand new daily squeeze fire long if the Dixie is above that 21 EMA. So that's the bad. The ugly would be HYG, the junk bonds. For now, the HYG kind of looks like it got the kill shot. It got sniped from a few hundred yards away. Takes out the daily 21 EMA, takes out the daily 50 SMA, takes out the daily 200 SMA. So you're breaking all your key moving averages. You're doing that with a daily squeeze firing short. You've got a brand new daily sell signal, and look at this mess on the heat map. We're bearish on the 1 hour, 30, 15, all the way down to the 1 minute. So that's the ugly. If we're going to get a short-term uptrend in the market, you've got to get a short-term uptrend in the Dixie. I'm sorry, you got to get a short-term uptrend over here in the junk bonds. So that's my issue right now. We've got daily squeezes, we got daily buy signals. What we don't have is confirmation from two really important pockets of the market, one being the dollar and the second being HYG. So it makes it a really tricky spot, guys. Before I would look to get long again, and right now I got a couple things open. We're long Chewy. Got a couple more trades open, but point being, before I'm jumping into fresh long positions, I've got to get a break here in the dollar. And all of this has to happen pretty quick. Got to get a big break in the dollar, and somehow, some way, HYG's got to get itself. It's got to sober up here and get up off the floor. However, it doesn't look very likely based on the break of structure. So tricky spots here, guys. Indeed. Quick look at the futures. We are down a little bit, trading under the 21 EMA with a 1 hour and a 30-minute sell signal. So at a minimum, I think you want to be careful being long right now. Doesn't mean you have to short the market. And, this could all turn around. We could get back above 4,100. The Dixie could flush. HYG could rally. Certainly if those things do come together, it does kind of bode well for the upside. For now, it's not shaping up like that. So you have this negative divergence where, all right, the bulls are making some progress as far as the equities go. Right, Nvidia's been really strong. The semiconductors look good. The financials look good. So there is progress being made on that end. But then there's constant issues being developed on the other end. Every day the Dixie seemingly gets a little bit stronger, and every day the HYG here continues to look a little bit shittier. So my thinking here, guys, is totally pumping the brakes on fresh long positions. And then I might be looking for a few shorts here. One thing I think is setting up for a short right now is actually going to be the Dow. And frankly, I don't trade the Dow too much. However, unlike the S&Ps and the QQQ, we don't have a daily buy signal. We actually have a daily sell signal. So this does kind of bode well for a big flush. A flush that could see you back towards 3,200-ish. I'd kind of look for a flush down towards your 200 SMA. So you got your previous big push. The indicator went from bearish to neutral, went from neutral to bullish, but then everything kind of died out. You lose your buy signal. You go into this 2-month consolidation, and now we're at the point here where in this daily squeeze, you got a sell signal, and it's a high compression squeeze. It's a highly debated topic here over at Simpler, but I'm kind of on the side of the high compression squeezes tend to fire short versus firing long. So I think some call credit spreads on the Dow. It all kind of goes hand in hand. If the Dixie 2 weeks from now, or the bond, if the Dow 2 weeks from now is trading at 32.5, your S&Ps, your Qs, everything's probably going to be much lower. So all things to pay attention to, guys. You might want to start thinking about some out-the-money call credit spreads as a starter position. Go out to March, maybe go out to April. And then if things do continue to break, then maybe you're looking for some long puts or some put debit spreads. But most importantly, before you get long again, look for a big break in the dollar. All right, and again, we're talking about a break that sees a Dixie back under 103. It's got to go back to where it came from. You need, at this point, a pretty significant rally in HYG. Even back above 75, it's still a little bit suspect. So for now, that's the chart that has me thinking the bulls might be screwed here. But before you get long, you want a big break in the dollar. You want a big old whopping short squeeze in HYG. And then as far as our lower time frames go on the indices, it's a total mess right now, guys. We're bearish on the 1 hour, 30, 15, 5, and the 3. So none of that, of course, is bullish. So big break in the dollar, big rally in HYG, and then our lower time frames on the S&Ps and the QQQ, they got to start turning the corner. Let's get some 30-minute buy signals, some 15, some 1 hour buy signals. Then maybe we got something to work with. But that is it for this morning, guys. Be cautious. Be a little bit careful if you're currently long. I would avoid getting on new long trades for now until everything we discussed here this morning starts to shape up. And of course, in the event it doesn't shape up, we got some air pockets here. So you could be looking at a pretty good flush over the next handful of weeks. Time, as always, shall tell. But as always, guys, thank you for watching. Hope you found it helpful. Have a good weekend. As a reminder, the market is closed on Monday, so we will get back to work here on Tuesday. Talk to you then.